This week, S&P Global Energy released projections suggesting that refined fuel demand is set to fall by 4.4 million barrels per day in the second quarter of 2026, more than double the worst quarter of the 2008 financial crisis. On Monday, the IEA confirmed that global oil inventories were drawn down by 117 million barrels in April alone, on top of 129 million in March, what the agency itself described as a record pace. And in a recent note, JPMorgan warned that April's global oil demand collapse was nearly double the peak loss recorded during the 2008 crash. Taken together, these data points suggest that the energy shock triggered by the war in Iran and the closure of the Strait of Hormuz has now tipped the global economy into what analysts are calling a phase of demand destruction. So in this video, we're going to explain what demand destruction actually means, why the data is now worse than 2008, and what it implies for the consumer, corporate earnings, and a stock market still trading near record highs. If you love staying informed and want some of the best reporting on YouTube, then subscribe and ring the bell for more. First, though, some background on how we got here. As a reminder, the US-Israeli war on Iran began on the 28th of February this year, and since then the Strait of Hormuz, which historically handled around 20% of global oil and gas, has been effectively shuttered. There's now a so-called double blockade in place, with Iran restricting transit through the strait under its own routing system, and the US enforcing a separate naval blockade on Iranian ports since the 13th of April. A fragile ceasefire has been in place since early April, but it's reportedly on, in the words of one analyst, massive life support. And Iran has reportedly restored operational access to the majority of its missile sites along the strait, according to analysts tracking the conflict. For context, demand destruction is the term economists use for a permanent, price-induced reduction in consumption. It's not a temporary slowdown. It's what happens when prices rise so high for so long that consumers and businesses structurally alter their behavior, cutting trips, shutting factories, switching fuels, going without, in ways that don't necessarily reverse even if prices later fall. Essentially, it's the economy's forced adjustment mechanism when energy becomes unaffordable. And the data on that adjustment is now pretty stark. According to S&P Global, refined product demand is set to fall by 4.4 million barrels per day in Q2, with a further 2.2 million per day decline forecast for Q3. JPMorgan independently put the April global demand drop at 4.3 million barrels per day, which it described as nearly double the peak loss seen during the 2008 financial crisis. Brent crude is now trading around $111 a barrel. U.S. gasoline is averaging roughly $4.52 a gallon, up about 44% year-on-year, and jet fuel prices have surged sharply since the war began, by some industry estimates as much as 80% or more. Americans have faced a dramatic increase in fuel expenditures since the conflict began in late February, with the added burden running into the tens of billions of dollars by some estimates. And the IEA's emergency stock release of 400 million barrels, of which 164 million has already been deployed, is, by the agency's own estimates, only buying the market 60 to 80 days of partial offset. So, why is this worse than 2008? Well, the obvious answer would be that the numbers are simply bigger, and they are. But the more important difference is structural. In 2008, demand destruction came after a financial collapse that killed consumer demand, and oil prices then crashed from a peak of $147 a barrel as a result. Today, the sequencing is reversed. Supply has been physically removed from the market by a geopolitical event, and demand is being destroyed at elevated prices, not collapsing ones. As such, there's no easy mechanism to restore supply even if prices keep rising, and it's already bleeding into the rest of the U.S. economy. Headline retail sales rose 0.5% in April, but stripping out gasoline, growth was just 0.3%, and in real inflation-adjusted terms, retail sales actually fell 0.15%. Department stores were down 3.2%, furniture down 2%, clothing down 1.5%. In other words, the entirety of the headline figure is essentially Americans paying more at the pump. It's a zero-sum shift, with every additional dollar spent on energy coming out of discretionary categories. So, what's next? The bull case, which we should fairly acknowledge, is that Q1 earnings were genuinely strong, with 84% of S&P 500 companies beating estimates and earnings growing roughly 27% year on year. But that's a backward-looking number, especially since a disproportionate share of 2026 earnings upgrades has been concentrated in a handful of mega-cap tech names, including Alphabet, Amazon, and Meta, according to analyst estimates. Meanwhile, dozens of S&P 500 companies have already withdrawn or cut guidance, and many more have flagged a material financial hit from elevated energy costs, according to analyst tracking of earnings calls. Whirlpool has reported what it called a recession-level industry decline, and McDonald's CEO has said the economic backdrop may be getting a little bit worse. With the Shiller-Cape ratio sitting near 40, more than double its long-term average of roughly 16 to 17, and approaching levels last seen only during the dot-com bubble, even Jamie Dimon warned this week of, in his words, a little bit too much exuberance in financial markets. As such, whether Q2 and Q3 earnings can absorb a demand shock of this magnitude without triggering a meaningful repricing remains to be seen. But with the Strait still closed, inventories drawing down at a record pace, and the consumer visibly cracking, the gap between what the data is saying and what the market is currently pricing in looks increasingly difficult to sustain.